This is the Essential Podcast from S&P Global. My name is Nathan Hunt. Private credit markets are expanding rapidly as companies and investors realize the benefits of balancing private loans and broadly syndicated loans. Tapping into each market as needed, fixed income markets are beginning a major transformation. But there are still some challenges around private debt. This is a market with very few participants. It's a buy and hold market, and a lack of liquidity can lock up capital for years at a time. Enter tokenization. By breaking private loans into tokenized assets, lenders can share the risk and investors can gain access to this growing market. It's an elegant solution to an intractable problem. So why hasn't tokenization taken off in private debt? Today, I'm joined by two specialists from S&P Global Ratings who have been looking at private credit and tokenization, Andrew O'Neill and Evan Gunter. We're going to get into the practicalities of tokenized private debt and try to understand what could unlock this new market. Andrew and Evan, welcome to the podcast.
Thanks for having us, Nathan.
Let's start by sort of level setting. Obviously, private credit markets have expanded very rapidly in a relatively short period of time. But can you explain to me some of the problems and the limitations in private credit as the market exists right now?
So, as you mentioned in the intro, private credit is it's a hot asset class. It's growing, but it does have its challenges. It was interesting. We looked at a survey of asset managers and wealth managers from our colleagues over at Coalition Greenwich. They found that over 60% of those managers surveyed were planning to increase their private credit allocations over the next 12 months. But still, even though they are planning to increase their allocations, the majority were still flagging several barriers that were viewed as holding back even higher allocations. Some of these barriers were including liquidity, transparency, manager fees, as well as the default risk. But these barriers are all kind of key characteristics of private credit. These are kind of part and parcel of what makes private credit what it is. So for instance, with liquidity, you mentioned there's no secondary market for these loans. There's an illiquidity premium where the investor is getting a higher yield for those assets. But also, since there's not a secondary market, the valuations are not as volatile as those that might be traded on a market. For transparency, it's a market that consists of private borrowers. There's a lack of public filings from these borrowers, and there's limited information on the funds that are holding the debt, as well as, like I mentioned, there's not a secondary market, so you don't have that trade data either. For manager fees, it's an alternative asset class. 2 and 20 is common for a fee structure, and there's also the operating expenses from legal and accounting that adds to the expense of this. And then when we get to the kind of the fundamental part of it, the default risk, borrowers in private credit tend to be smaller. From the section of the market that we have credit analyses from our credit estimates, we can see that the distribution of these borrowers would be in the very low spec grade. It's a cohort of borrowers that tends to be smaller and on the weaker side of credit. So there's a natural credit risk with this pool of borrowers.
Okay, so we have, as challenges, we have a liquidity challenge, we have a transparency challenge, we have a challenge in terms of management fees, which, as you said, are higher than are in broadly syndicated markets, and you have a challenge in terms of credit risk. How would tokenization, or how could tokenization help with these challenges?
So it's interesting that the solutions that could be provided through tokenization, you really see this could really be adjusting some of the technical considerations, or could be addressing some of the technical challenges of the private credit market. So, for instance, liquidity. Once you are trading something on a digital markets are open 24/7. There's an added ease of transaction. It would be easier to buy into funds or to trade shares, and that could potentially broaden the investor base. For transparency, uh, the transaction flow, if it's on a public blockchain, would be part of a shared public ledger. You would see that transaction flow. It would be visible to all parties. And you would also have the real time settlement of transactions. Through the public ledger, you could see concentrations, you could see secondary pricing. While it wouldn't lead to public filings of the borrowers, it would lead to more transparency for the market dynamics themselves. In terms of manager fees, uh, there are opportunities to save on back office costs through the use of smart contract templates. It could potentially lower transaction costs, lead to lower management fees, and I think the idea that many of the proponents are suggesting is that it could reduce the need for some intermediaries. So those are some of the technical benefits or technical challenges that may be addressed through tokenization. But there's the fundamental challenge of private credit, which is default risk. Uh, and in that sense, the fundamental credit risk is still going to be there for the borrower because credit is still going to be credit. The quality of the borrower is what ultimately matters. And that's regardless of whether the asset is on chain or whether it's not.
So let's dig into this a little bit further. Tokenization has the potential to expand the investor base and potentially the borrower base as well. What are the mechanisms that allow that expansion to happen?
So the short answer is that this could open the door to new lenders, to new borrowers, and to new investors. I like to think about private credit as kind of like it's traditional lending that's coming from non traditional lenders. The backstory of this is that as banks stepped back from lending to corporate borrowers, after they stepped back from lending to corporate borrowers after the GFC, stepping back from some of those borrowers that might have been viewed as risky, alternative asset managers stepped in, providing credit, lending to some of these corporate borrowers. Traditionally, we've thought about private credit as middle market corporate lending from alternative asset managers. Now you're seeing it extending to a wider mix of borrowers, including larger corporate borrowers, as well as things such as project finance and asset backed finance. The investors in private credit are largely institutional, includes pensions, insurance companies, asset managers, and on the individual side, also high net worth individuals. So while private credit has been growing and has been extending out to reach different borrowers, different investors, on a parallel track, you also have digital markets evolving. With this expansion of digital markets, they're reaching to provide real world assets that have been tokenized on blockchains. So if you have these digital market credit platforms evolving, you're looking at new platforms extending credit, borrowers finding new ways to access those lenders, and you also have investors that have new ways to access to provide capital into this asset class. Through those doors, you could see an expansion of the market.
So let's talk a little bit about the borrowers. It seems clear to me that as of now, S&P Global hasn't issued any ratings on tokenized private debt. So who are the borrowers in this market? What's their credit profile? Who are they?
So, Nathan, just to start, I guess so we at S&P have not rated any tokenized private credit yet. We have rated plenty of digital bonds issued by traditional bond issuers across a range of different sectors. And so I'd come back to a point that Evan was making, separating the technology from the underlying credit. So in terms of the technology, these are areas that we've explored pretty deeply and are quite familiar with. In terms of their application to the private credit space, we see two broad types of application. One of them is the tokenization of shares in an existing fund. And so here we've seen, for example, Hamilton Lane tokenize one of their private credit funds on now multiple blockchains, recently expanding that to Solana. And so this is where the underlying fund is what it always has been. The underlying credit, the borrowers are what they always have been. They are private credit exposures, and those borrowers have no reason to be aware that any tokenization has happened on the fund itself. But there's an opportunity to invest in that fund through a digital platform and acquire shares in the fund at tokens, potentially in lower denominations than would be available in traditional markets, and with more flexible redemption terms. So there's some benefits to investors there. So that's one type. The other type is the emergence of decentralized lending protocols. This is much more in a much more disruptive direction, technologically disruptive. And this is where we see protocols emerge around specific blockchains, mainly Ethereum, where a smart contract is created on the Ethereum blockchain, for example, and allows both investors and borrowers to interact with the protocol. And these protocols create structures that look very much like securitizations, and they aim to make that link between underlying borrowers and investors. The underlying borrowers themselves, again, may be fairly traditional in the sense that they would not have necessarily any digital aspect to them. They may be very straightforward off-chain loans to small and medium enterprises in a given country. But what's different is that there are tokens created to represent those loans on a blockchain, and those tokens then designate ownership of the loans, and the smart contract that's on the blockchain operates the flow of funds from borrower payment through to payments to investors. So that's really just differentiating those two fact patterns. The first one, in terms of tokenizing a fund, that's something that's perhaps more low-hanging fruit in terms of future developments, whereas the decentralized lending protocols probably face a longer time to scaled adoption.
Forgive me for asking such a basic question, but I'm really curious, what is the process for tokenizing assets? How does a loan become tokens?
The loans themselves and the structures will often have many of the features of traditional loans and securitizations. So, for example, there will be contracts for loan agreements. There will be a special purpose vehicle issued in a very similar way to what we might see in securitizations in traditional markets. And there will be contracts between transaction participants and the special purpose vehicle that's issuing the tokens. What's different is that the transactions that occur through the exchange of tokens on a blockchain. They use on-chain payments. One of the regulatory challenges, and in some jurisdictions, is that it may be as yet untested whether those tokens provide the same rights to investors as, say, debt issued in traditional form. There are some jurisdictions that are more advanced in that regard, and I think we might get to that a little bit later in the conversation. But certainly that is a question that needs to be considered when looking at these transactions that are done through decentralized lending protocols. How some of those kind of basic tenets of a traditional structured finance legal analysis work in this new digital landscape. If we come back to the kind of first example of the tokenized fund, again, that will look very similar. Indeed, the non-tokenized version of the fund exists. The tokens just provide another vehicle to investors to own shares in that fund. And so The only thing that's changing is how investors access it. It will be through a specific platform that's offering that service, that takes a fee for that service, but in exchange provides some additional flexibilities to investors relative to buying the traditional shares in the fund.
Excellent. So, as Evan had mentioned earlier, liquidity is intended to be one of sort of the main benefits of these tokenized private loans. How has that worked out in practice so far? Understanding that it's still early days in this market, how much has tokenization added liquidity to these markets?
So to kind of level set, I just want to talk a little bit about private credit because people talk a lot about the illiquidity in private credit. On the asset side, the private credit loans largely consist of direct lending, loans that are made directly between the lender and the borrower. These are not broadly syndicated. There's not much of a secondary market. And these loans are largely buy and hold. In return, the investor gets an illiquidity premium, or they get a higher yield than they would on a more liquid asset. So while the underlying assets have illiquidity, also many of the investor vehicles that investors are using to invest in private credit also have limited liquidity. For instance, a middle market CLO, there's less trading on that in a secondary market than you would see for a BSL CLO. Another investor vehicle that invests in private credit is the business development companies, the BDCs. And the sharpest growth we've seen over the past year in BDCs has been in the non-traded segment of these, where they're not traded actively on an exchange. Separately, another common way to invest in private credit is through a private credit fund. And for the investor that wants liquidity, whether they want to add investments to the fund or make redemptions, they're interacting directly with that fund manager. So it's interesting that one of the early test cases of alternative asset tokenization, it's what Andrew was talking about, the tokenization of a fund. We saw, I think it was back in 2022, a private equity fund, KKR's Healthcare Strategic Fund, tokenized shares. So it had a tokenized share class of this fund. It was kind of a test case, maybe a proof of concept, but maybe this was a case to see if through the blockchain they could enable a more liquid type of share class. So with this, I'll hand this over to you, Andrew.
Yeah, thanks, Evan. I think that idea of the more the increased liquidity through tokenization is something that will be a long time coming and requires a much broader adoption of tokenization by investors and by asset managers in particular. So when we talk about tokenization enabling liquidity, often the conversation starts from the point around fractionalization, where premise being that for some of these alternative asset classes in particular, the minimum investment thresholds today are what stop people from investing, and so you unlock all these additional investors if you can fractionalize that. Maybe that will move the needle a little bit, but the more transformational aspect here comes from improving asset managers' ability to invest in alternative asset classes, and that is not specific to private credit, but it comes from the much broader adoption of tokenization in asset management, and we're not there yet. So when I think about the digital bonds that we've rated at S&P, so these are some of the. So when I think about some of the issuers for which we've rated digital bonds, these are some of the stalwarts of the global bond markets. We've seen these issuances now across regions, across sectors. Those digital bonds are not yet traded. There is no secondary market to speak of yet. When we look at tokenized money market funds, same thing. These are still nascent markets, and a secondary market has not yet developed. And when we look at these decentralized lending protocols that I've mentioned, they also have not generally not enabled their secondary market features. So a lot of those tokens are even coded to be initially non-transferable, which is intended to be changed in time. But as of yet, there is no secondary trading for these assets. So in terms of progress towards using tokenization to develop liquidity in private credit, I think we're still very much at square one. But so when I think about what's going to enable progress, I'm thinking in much broader terms, what's going to bring liquidity to tokenized markets more broadly, what's going to lead to more investor adoption of these tools. Because ultimately, when asset managers start holding most of their assets in tokenized format, that enables things like the use of smart contracts to manage portfolios, to rebalance portfolios, and it enables a lot of efficiencies in terms of trade settlement, etc. So I'm just going to talk through some of the key challenges then to why that's not really happening yet. So the first of those is that there's a lack of technical interoperability. So there are different blockchains, different standards. Some institutions will have developed a private blockchain in-house that can work quite well for transactions involving their specific clients, but are pretty much walled gardens in terms of being able to transact across different institutions to build a market. They don't really support that. There are public blockchains that exist that are much better in terms of openness, creating that marketplace, but investors may face regulatory uncertainty in terms of how they engage with those chains. There is also technical risks that investors would need to be familiar with before they did so. And even then, there are still different chains, different token formats. Until there's a convergence around a specific standard, then that is going to be a challenge, that lack of interoperability. And in a similar vein, there needs to be convergence around certain solutions for on-chain payments. So when we're thinking about using blockchains for financial transactions, blockchain payments cannot be done through wire transfers in using traditional rails, or at least traditional rails can be used alongside a blockchain, but then you don't really get much of the benefit of tokenizing the asset in the first place. We've started to see some innovation on this side, particularly in the digital bond space, using wholesale central bank digital currency. We've also seen, although not yet rated, bonds that have been issued using stablecoins, so cryptocurrencies that are pegged to the value of a fiat currency, and that technically enable a blockchain to be used for a financial transaction. And we're starting to see in key jurisdictions regulatory frameworks emerge around stablecoins in particular that may support better investor engagement, better agreement around what is a robust stablecoin. And so that element of regulatory clarity will help as well. So we've seen some jurisdictions where legal frameworks have been updated to consider the nature of digital securities. We looked at places like Switzerland, like Luxembourg. We looked at Singapore, Hong Kong, where legislators and regulators indeed have put a lot of effort into considering the impact of digitalization and the interpretation of digitalization in the context of their legal frameworks. And so then just coming back to the point of investor familiarity. So ultimately, investors want to buy, let's say they want to buy bonds. They don't want to be experts in 6 different platforms that might enable them to do so. And they don't want to be having to move assets from one platform to another. So until a lot of that technical complexity can be abstracted away, for investors, or there can be convergence around common technical solutions. That is going to hold all of this back. But once that emerges, once investors start to hold more of their assets in token formats, that's where there may be an inflection point in terms of adoption, and indeed in terms of enabling some of the use cases with alternative assets.
So you've mentioned KKR. Are these the leaders in this tokenization of asset space? Are there others?
If I come back to the two formats that I was talking about before, so on the one hand, we've got the decentralized lending space. So all of this is still very nascent. So ultimately, who the winners will be, time will tell. There are some platforms out there, such as Centrifuge or Maple, that dominates today in terms of the on-chain lending. When I talk about Centrifuge, so this is a protocol through which originators can create securitization-like structures, and indeed that's the kind of largest platform in terms of lending to private credit today. When I think about the more institutional side, I think that's where it's interesting to look to some of the pilot projects that have emerged recently, and in particular under the banner of Project Guardian, which is a global research effort that's led by the Monetary Authority of Singapore. There were a couple of interesting reports published end of last year and early this year, where some of these institutions have worked on pilot transactions to demonstrate the use case for tokenization and smart contracts in asset management. And the clear implication there in terms of the benefit of using the technology in asset management is that it ultimately allows the asset manager to hold assets across all asset types in a common format and in a way that's operationalized through smart contracts, and creates meaningful efficiencies for asset managers. And so when we see the applications today in financial markets, that we're seeing bonds being put on chain, we're seeing money market funds being put on chain. These are the easy to understand liquid assets where some of these small operational benefits can be realized, where investors can become more familiar with the technology as that expands, as the technology gets expanded to different types of issuer. That's where more investors dedicate more of their portfolios to tokenization, and potentially can find it easier to allocate funds to private credit. That's I guess we're several steps away from that, but I think it's interesting to see institutions such as JP Morgan, Apollo, Citi, Wisdom Tree working on these fully worked through pilots to demonstrate that use case.
You talked a little bit about regulation, and I'd like to dive into that some more. As we know, credit markets are highly regulated, and this being a new space, there will obviously need to be some new approaches to regulation. You've talked about Switzerland, you've talked about Luxembourg, you've talked about Singapore, looking at tokenized assets and tokenized private debt. How would regulation have to change in order to accommodate these markets?
So there's several aspects to that. One is just looking at the nature of digitalization and recognizing that in a legal framework, that digital ownership of a financial security, for example, represents the same rights under law as traditional securities have to date. So that's one point, but that's the most direct. Regulation can then also bring certain requirements for roles in these transactions, and so I'm going to talk about this as a regulatory point, but maybe more regulation adjacent. We'll still need to see various trustee type roles and agent type roles in these transactions. The definitions of those roles may change, but they will be important still to protecting investors' rights in transactions, indeed to representing investors through the life of transactions. Beyond that, existing legal and regulatory frameworks will still have a lot of what's required, because ultimately what we're talking about here as an underlying financial asset is a credit asset for which existing regulation should apply. The fact that it's been tokenized, that there's a layer of infrastructure added on top, it doesn't completely negate that. That said, the fact that that public blockchains may be used, for example, may introduce a bit more uncertainty, and that's where there may be, at least today, differences between jurisdictions in terms of the likelihood or the comfort that that institutions will feel in experimenting in that space using public blockchains in a context where regulators have been either silent or kind of openly skeptical about their use.
You talked a bit about sort of the regulatory adjacent roles in credit markets today. And I'm wondering specifically about credit ratings. Is it possible for there to be a credit rating for a tokenized private loan in the way that there are credit ratings for broadly syndicated loans today?
I think Andrew put it really well when he said that when it comes to tokenizing private credit, we're still at square one. There have been other types of assets, real world assets that are being tokenized, such as bonds and money market funds. Private credit is really on the frontier of the sort of what you call the real world assets being tokenized. There's a lot developing in this space. And likewise, there's also a lot happening in the realm of fund finance right now. There's a lot of innovation that's taking place. So, for instance, private equity funds, private credit funds have been looking for new ways to diversify funding. And some of these ways include raising funds through subscription lines, through NAV loans, and also through capital call facilities. The fund structures are evolving. And in some cases, we're also seeing the blurring of lines between what's a private credit fund and what's a CLO. Some of the private credit funds have been using tools from securitization. This can include credit tranching, also payment waterfalls, and this is leading to some hybrid structures. These structures that sort of blur the lines between what's a fund and what's a CLO. On the fund side, we've been rating alternative investment funds at S&P Global Ratings since 2006, and we've been updating our criteria along the way. One instance of this is that we recently updated our methodology for how we rate subscription lines, and we updated that criteria this summer after a request for comment that came out earlier in this year. So while we have established ways to rate funds, and our methodology and our criteria have evolved over time, I'm going to hand it to Andrew now so that he can talk about what are some of the ratings considerations for things once you start getting into DeFi securitizations.
Yeah, so we put out a report last year on DeFi securitization protocols. And so I'll start just with the obvious point that we made earlier, that ultimately the underlying loans are what they are. The credit risk is the credit risk. And so we have approaches, methodologies across regions and sectors for analyzing a pool of borrowers and for coming up with credit loss assumptions at different rating levels. So that's no different here. Some of the early use cases, most of the early use cases perhaps for decentralized lending protocols have so far been in areas that have less access to traditional markets. So that may be borrowers in emerging markets or quite niche borrower types in more established markets. So that those will have a degree of credit risk to them. They may be non-traditional borrower types that we've yet to develop a methodology to analyze, but in principle, the underlying borrowers will be real-world borrowers and may well fit within a methodology for analyzing credit risk in pools of loans. When we then look at how that fits into a structure, the legal plumbing of a traditional securitization, at least in the examples we've seen, has usually been there. And so there will be elements of digitalization that introduce some new questions, that introduce basic legal questions in a bit of a new context that will need to be explored. But fundamentally, a lot of what's there is very familiar. So when you overlay this technology on top of it, there's some few additional considerations. When we think about smart contract risk in particular, is there any vulnerability to errors in the code, to the transaction or to the smart contract doing something that wasn't contemplated in the transaction documents, or indeed to vulnerability to some attack from a malevolent actor? There are ways in which those risks can be mitigated. There are very well battle-tested standards for certain types of smart contract. There are also increasingly established audit frameworks for mitigating risks. And then there are various permissioning mechanisms that can give some comfort around who is actually able to engage with the protocol at all. So that's kind of one aspect, the smart contract risk that's novel. The other angle is what I was talking about earlier in terms of on-chain payments. So where if you have a pool of borrowers that have taken out loans, let's say in US dollars, in order to operationalize a transaction through a blockchain, you need to use some digital currency to do that. So it will use some form of stablecoin. Different stablecoins come with different risks. They may be subject to the credit risk of an issuer. They may have segregated assets in reserve that can help defend against their can help defend their peg, and the nature of those underlying assets may include higher or lower credit quality assets, more or less liquid assets. All these factors can lead to a stablecoin that is more or less likely to maintain its peg to the dollar. So if you're in a situation where you want payments to flow from borrowers through an end investor, it is really important that if you're using that stablecoin as a tool, that it maintains its value at $1 through the life of the transaction. So understanding that risk, understanding perhaps also what contingency plans may be embedded into a transaction in the event that there was a depegging event, those become key areas of focus for risk analysis.
Well, I would love to have both of you on again to talk some more about stablecoins, the depegging of stablecoins, and some of the analysis of stablecoins that has been published by S&P Global Ratings. Evan, Andrew, thank you so much for joining me today on the Essential Podcast.
Thank you, Nathan.
Thank you, Nathan.
The Essential Podcast is produced by Patrick Moroney. At S&P Global, we accelerate progress in the world by providing intelligence that is essential for companies, governments, and individuals to make decisions with convictions. From the majestic heights of 55 Water Street in Manhattan, I am Nathan Hunt. Thank you for listening.